So let's talk a little history or evolution of the profession and your programs. The financial crisis of 2008 was something of a watershed, I think you'd all agree. Can you put in a few words how that changed things in the way these types of programs operate, how you've structured them, how you responded, and I presume there's also some upsurge of interest in your programs post-crisis.
First of all, it destroyed smugness. Every time a major shock occurs, minor shocks also you learn something, major dislocations you learn a lot. Simple things that you take for granted, covered interest rate parity failed during the crisis. It called existing theories and existing frameworks into question, not in terms of the frameworks themselves, but in terms of what was taken for granted in those frameworks and never quite explicitly discussed.
Yeah, I think that's right. I think there are two things. One is the middle offices of financial institutions have been recruiting huge numbers of additional staff. I mean, the banks in Toronto, for example, have increased their headcount in the middle office by between 30 and 50% over the last few years. And that means there's lots of jobs for our students in middle office. So that means, that they're going to be a lot more interested in risk management courses, risk management electives, that sort of thing. Every time there's talk of a possible new regulation coming out of the Basel Committee or Dodd-Frank or whatever, a bank has to set up a group of half a dozen people to think about it and decide how they're going to respond to it and so on, which is a source of additional employment. The other thing is that the whole environment in derivatives and risk management has changed as a result of the crisis. I mean, prior to the crisis, the over-the-counter derivatives market was essentially unregulated. Now it's highly regulated, and that changes what we have to teach. As I said earlier, the regulatory environment changes every year, and we have to make sure we're up to date with what we're teaching, which is actually, some of the practitioners in some of the sessions here have said one of the major problems they have is keeping up to date with the new regulation. We have exactly the same problem as instructors in courses.
In view of the explosion of information and pace of change, including in the regulatory sphere, how do you keep up?
With difficulty. What I try to do is attend maybe 4 conferences like this GARP conference every year, because I find that conferences which are academic practitioner conferences as opposed to pure academic conferences do help keep me up to date with the latest thinking. And unfortunately you have to read documents like Basel II and Basel III to keep up to date. It's not fun reading, but you have to do it.
We can do that, go to conferences and keep up and read the Financial Times and subscribe to Morrison and Foster's service on Dodd-Frank developments and Senate hearings and all the rest of it. But the students really can't do that because they have so much work. You can't load them up with a whole bunch of stuff that's going to change anyway, and it's not going to be relevant to them until they get into a job, right? But they do need to know the shape of it, the context of it, and the major difference in the major developments. And certainly the faculty has to keep up.
In the wake of the crisis, did you find yourselves or your associates or your schools revisiting the degree to which programs and risk management had become quantitative rather than some mix of quantitative and qualitative? Did the models take over too much? And did you have to revisit that?
No, I wouldn't quite say the models took over. I think what we, as I said, did not fully appreciate was some of the assumptions in those models that we took for granted, that we live in a world in which trades can be done in a liquid fashion. Some of the assumptions failed us, and what was highlighted was 2 separate things. One is the shortcomings of certain models, and one was the importance of certain assumptions that we didn't previously give enough importance to or credence to. In a sense, when you ask the question as to rely less on models, no, models are what we use to understand the world. Models are simplifications of the world that enable us to distill the world. But I don't view this as conflicting issues of moving towards qualitative analysis versus quantitative analysis. Models help us understand the world, and understanding the shortcomings of those models helps us build better models.
Underlying your question is, were models the cause of the crisis? And I don't think so. It's people who caused the crisis. I don't think you can blame models. And that's what I try and teach my students. The Gaussian copula model is a great model. I mean, we taught it back in 2005 before the crisis, and we teach it now, but now we teach it with a lot more understanding about, the sort of somewhat dodgy assumptions that underlie the model. I mean, a model is just a tool for thinking about the world. All the models we use in finance are pretty poor models as descriptors of reality.
Yes, I agree with that. And, even as John says, models which everybody knows are wrong, like the Black-Scholes model, are still useful. I think it was George Boxer said, all models are wrong, but some models are useful. One of the things I have seen, though, with the increasing emphasis on risk management since the crisis is also an increased emphasis on enterprise risk management and the processes of risk management in financial institutions. How do you manage risk management and how do you create a risk management culture? So operational risk management seems to have gained importance. Enterprise risk management seems to have gained importance. The process of doing self-assessments of your risk factors and different groupings within the corporation. There seems to have been an increased attention to that because the failure of people was also a failure of the culture or ignoring the processes that were formally in place in the company.
If you talk about people who are quants out there working for banks, there's two sorts of quants. There's the quants who only ever talk to other quants, and they're never going to get promoted very far in the bank. And then there are quants who go to meetings and try and put themselves in the position of somebody who's not a quant at the meeting, and how, what's really important to this guy, what does he really need to understand about what I'm doing? How can I explain what I'm doing to this person? That quant is going to be successful. So that's what we try and teach students, both MBAs and Master of Finance students. We run optional workshops on communication, and guess who comes to those optional workshops? It's the students who are already quite good at communicating. The students who really need the workshops don't come.
You're trying to communicate complex ideas that obtained maybe through complex models in a simple fashion. It's something that in our Masters in Risk Management program that we try our best to integrate it into every aspect of the program. Not all of us will become great teachers even with a lot of effort, but all of us can become good teachers or good communicators with effort. And the key thing is to emphasize the importance of putting in that effort, of explaining why it is important that you need to communicate well.